Hello and welcome back to the note. Well, the Fed had its last opportunity to avert us to the possibility of a rate hike next month today with the publication of its minutes, and I think we can safely summarize that with the words "move along now, nothing to see here." They were a very balanced set of minutes. The critical thing you need to know is that it described a few members as considering a rise in June, and many members as ruling that out. I think that's enough to say that it's not happening in June. They still remain very data dependent. The judgments in the data that they cover in those minutes were extremely nuanced. They remain very intrigued by the strength of the labour market. On balance, I'm inclined to agree that they perhaps somewhat more preoccupied with downside risks, and that is because of what is emerging as quite a big conundrum, which is why the fall in the oil price, which was supposed to be almost like a tax cut for US consumers, has not had that effect. Retail sales do not show it. Consumer sentiment surveys do not show it. Now, where does that leave the market as we continue to try to position ourselves for what will eventually be a rise in rates? Well, if you take a look at the dollar, it's up some 20% against the euro since about a year ago, the peak last summer. It has, however, seen quite a correction, back some 6% since its extreme, and that seems about right. The divergence trade got taken a little too far, the notion that the Fed would be tightening while the ECB cut. Now that is in abeyance. However, as it is still very likely that that is ultimately what's going to happen, it remains a justified level. If you want to take a look at bond yields, remember they peaked after the taper tantrum of 2013 at just over 3% on the 10-year. They have dropped as low as 1.64. They are currently hovering around 2.5%. That's where they've been for a while. Again, that probably makes sense. We are in suspended animation waiting for the Fed. As for the S&P, well, it's just slightly off its all-time record at the close today. It's up 13 or so % over a year, which historically is extremely good. It's only up about 3% for this year so far, which is nothing terrible, but suggests that momentum at least may be slowing, even if it's not reversing. What we really need to know is when the Fed raises rates. I tend to agree with Alan Ruskin of Deutsche, who makes the point that we are still not priced for a rate rise within 6 months. If the data begins to strengthen, if you do see the consumer beginning to spend their oil bonus, that does mean that a September rate rise is still quite likely. That is not currently in the price, so it is likely to mean higher bond yields, a stronger dollar, and weaker stocks. But we need the data to come through first. As for June, nothing to see here.